Hi, I'm James Gerrish and welcome to another Market Matters weekly update. Today I'm joined again by Charlie Aiken from Aiken Investment Management, the Chief Investment Officer there. Thanks for coming in again, Charlie, appreciate it.
Jamie.
I want to take a little bit of a different tack first up today and look more around risks as you see them in the market at the moment. We've obviously got the second longest bull market in history. We're a couple of months away from taking out the gong as the longest bull market in history. S&P 500's up around 400% since 2009. What do you see as the risks here? What are we going to look back in 12 months' time and say we should have seen that coming? We should have seen the risks that were there in front of us and we didn't. What's the thing that keeps you awake at night?
Yeah, well, I mean, look, we're probably closer to the end of the bull market than the beginning, obviously, without stating the obvious. I think what worries me the most is the relationship between growth and value now. We're seeing this euphoric rally in growth to an unprecedented level. Anything with growth in it is going to an unprecedented PE over anything that's got value. And so that worries me. That's generally how markets end, a euphoric end in something. Obviously at the moment it's very tech related, very platform related. And that does worry me. It also worries me that the market's underestimating how hard the Fed's going to have to go. You know, the Fed's going to have to raise rates hard. They're trying to tell you they're hawkish. You know, every party ends with the Fed taking away the punch bowl, and they're going to do it.
The bond market's not listening to it.
Well, the bond market is worried. The bond market's gone very flat. The yield curve's very flat. Every recession in America has been forerun by a flat yield curve. Yield curve's the flattest it's been in 10 years. So you've got euphoria in American tech stocks, euphoria in US equities, but actually if you strip out the tech stocks, US equities are down this year.
The industrials
are down, yeah. S&P's down, stripping out tech. And so there's this very narrow rally in America in a very narrow bunch of stocks, yet the flat yield curve, look, I think it could be now, Jamie. I wouldn't be surprised to see a 10 or 15% pullback in America very soon, very soon. I mean, this trade war stuff, or this fake trade war, whatever you want to call it, is not one-way traffic. You know?
Yeah, exactly right. It's one of the trade war will undermine confidence going forward. We just need that tipping point. You know, across our portfolios, we've started to go short US equities just in the last few days. We see there's a risk there.
I think that's right.
I want to turn there now to Asia. You know, Asian growth has been a phenomenal theme. It's been the right theme. There's been some great stocks picks over in Asia. You know, the rise of the Asian middle class. The removal of the one-child policy, etc. Asia is clearly a growth engine of the world. What's happening in terms of equities over there?
Well,
Chinese markets, bear market.
Tough. You know, well, obviously, you know, Chinese markets Hong Kong started the year really well. It's been a 20% pullback in Hong Kong-based equities.
Bear market.
Yeah, well, effectively a bear market. I mean, there's amazing value there. I mean, the HSC China Enterprises Index is on 8 times earnings versus the Nasdaq on 30. I mean, we can buy better growth in China in that market than we can broadly in the Nasdaq.
So now's the time to go. Take money out of the developed markets and go into the developing markets.
I think the developed markets are very expensive versus anything that's not developed. I wouldn't even call China an emerging market. I think that's ridiculous. I mean, Tencent, Alibaba, they're not emerging. I mean, they're proper large cap companies, you know. So for me, that disparity or that divergence is just enormous. So we have the vast bulk of the fund in Asia and consumer-facing stocks, Asian consumer-facing stocks, Chinese domestic consumer-facing stocks. They've been knocked around a bit this month. You know, we're having a reasonably tough month ourselves. But I find it impossible to believe that this is an Asian-centric event that has nothing to do with America. China's just cut interest rates. America are putting up interest rates. I think there's far better value in Asia and far better growth in Asia. And I think this American reaction about trying to put tariffs on China and slow China down is basically the acknowledgement that China is taking over the world. America's leadership of the world is finishing. You know, there's 365 million people. They're not going to lead the world.
What risk do you see in Asia? So is it around, you know, is there repatriation back of capital into the US around changing taxes and whatnot? Or what's the core risk in Asia if we're investing over there?
Well, a little bit is, you know, too strong a US dollar can undermine it a little bit. There's a fair bit of debt out there denominated in US dollars. But really, like if you're looking more than 10 minutes or, you know, 10 weeks, you know, the population growth, GDP growth, empowerment by technology, it's the biggest theme of our lifetime, and it is Asia. So I don't think any of the drivers of growth have really changed in Asia. Share prices have changed on a massive EM-DM rotation, but really I think that's just giving you a chance to buy the best structural growth stocks in Asia at really quite big discounts to everywhere else. So that's where we're focused. It hurts you a bit in the short term, but if we're sitting here in 2 or 3 years' time, I will be amazed if Asia hasn't outperformed America, albeit that I think you're at peak USA right now. Right now, peak US dollar, peak US bonds, peak US equities versus everything.
You talked about interest rates going higher, bond yields going higher. That, you know, anything that you've said it in the past, and we've had you on here before talking about anything that looks like a bond, anything that's obviously priced itself off interest rates, off bonds. You know, but is that a crowded trade now? Is that
it hasn't really worked, to be honest. You know, a few of those have worked and a few of them haven't. at the end of the day, what's happening now is the yield curve's flattening, the long end of the market, which if that is to be right, I need long bond yields to move, and they haven't, quite frankly. They haven't moved much, and the yield curve's flattened. So, and in Australia, look, it's, a lot of those stocks are relevant to Australian interest rates, which appear to be going nowhere. I mean, at the end of the day, the banks are raising interest rates, bank bill swap rates up. At the end of the day, mortgage rates are going up anyway, so the Reserve Bank's doing nothing. So, yes and no. I'm not 100% sure that's working. It hasn't worked brilliantly for us. We've had a few stocks that it's worked for that generally had profit warnings rather than bond related. But I'm not sure. I'm not sure the bond market with this very, very flat yield curve, 2 to 10s, is telling me to be worried about a lot of things. But, and so, if we do have that, some of those defensive stocks will probably hang in like they have recently. So I'm just not 100% sure on that, Jamie.
What about stock to buy now? What's something now you'd go out there and buy? What's perhaps something you'd buy into weakness if we get the 10% correction in US markets or global markets?
Yeah, look, I absolutely believe Wall Street's setting up for a 10 to 15% correction again. You can just see it. You've got euphoric retail buying. Buybacks have been something like 65% of turnover. It's all, it's all how it ends. Netflix, 121 times earnings, up 110% this year, 170 billion market cap. You're kidding, aren't you?
If you go out there,
you're kidding.
If you go and look at charts as well, we look at charts as a combination of things we look at. The Nasdaq's just broken through support. It looks pretty negative technically. There is money flowing out of the US. It is starting to show signs of peaking. A stock that you'd buy into weakness.
Stock in America I'd buy into weakness, something like a Microsoft, one of the world leaders in software or software as a service, but I wouldn't buy it here. If the market fell 10, 15%, hopefully Microsoft would fall 20%. That is a stock, something like that I would buy. Big blue chip global earner, that has a structural advantage. But that's free if that happens. In Australia, I'm really like this Clydesdale Virgin Money deal. I think that's a good deal. I think that's going to be a good deal. And I think there's big EPS upside and big synergy upside for Clydesdale there. So I really like Clydesdale. I think they'll be a good one. I'd buy them now or into a slight bit of weakness. And what would I sell? I tell you what, I look at some of these Australian technology stocks, if you want to call them that, they're farcical. WiseTech, Appen, Afterpay, ludicrous valuations. Ludicrous. And momentum investing is just feeding on itself. And I think you need to be very, very careful in anything domestic that looks like a tech stock that's on 60, 70, 80 times forward revenue. And I think that's very dangerous. If you're right and I'm right, the Nasdaq has a breather, some of those Australian tech stocks will fall 30, 40%. You need to be very careful. The difference between what a momentum investor will pay and a value investor can be up to 80%. You can see these huge caps. Look at Domino's Pizza, look at Ramsay Healthcare, look at these things. There's no buyer when they actually become, they've got to become deep value before people buy them. So I'd be very, very cautious on Australian technology stocks. I think they look very vulnerable to me.
Charlie Aiken, thanks for joining us.
Thanks, Jamie.